Welcome to the MUFG Global Markets Podcast. I'm your host, Ellen Tang, and today I am joined by Glenn Schultz, who is the head of our agency mortgage prepayment modeling and strategy for MUFG. Today is Thursday, December 15th, and Glenn, thank you for joining us today on this month's show and the last one for the year.
Hi, Owen. Yeah, my pleasure. Thank you for inviting me.
So as we always do, let's kind of kick off with the December remit data, which was released on Tuesday the 6th. It looked like aggregate prepayment speeds as measured by the Fannie Mae 30-year MBS declined about 16.5% down to 4.8 CPR. And then the 15-year prepayment declined about 12% down to about 5.5 CPR. So it really seems here mortgage prepayment rates have hit rock bottom against the backdrop of higher mortgage rates, tightening financial conditions, et cetera. I noticed in your monthly prepayment commentary that you mentioned that the PO value of the discount sector. Could we chat a little bit more about that?
Oh, yeah, sure. The idea there is that the expansion of the coupon stack, which was largely driven by the last round of quantitative easing, followed by the financial conditioning tightening, both of which driven by the aftershock of the pandemic and really, in my opinion, excessive government stimulus, has really created pricing across the coupon stack from a low of about 84 and change for the 2 coupon to a high around 102 and change for the 6 coupon. So this is something that we really haven't seen in a while across the coupon stack. So with discounts, say between 7 and 16 points, the principal only or PO value of these discount coupons becomes a consideration as small changes in prepayment assumptions can radically alter the relative value equation. And so that's what I really mean by the PO value. If you essentially move CPR assumptions by a small amount, you get a big change in value. So for example, in the case of the 2 coupon, a 4 CPR assumption results in a 3.88 yield and a 32 basis point spread to the curve. Whereas a 6 CPR assumption results in a 421 yield and 72 basis point spread to curve. So in this example, the difference is 32 basis points of carry, and a 6 CPR, at least in my view, is really not entirely out of the question. So I think there, depending on your prepayment expectations or forecasts, there's a substantial amount of value in the discount sector.
Thanks, Glenn. I see your point there, which leads me to my next question here. What does the MUFG prepayment model forecast for, say, 30-year conventionals? And then could you talk a little bit about your view for prepayments going into 2023?
Yeah, sure. Fair enough. In terms of long-term CPR, right, the model forecasts are as follows. So the model thinks 2s are going to turn in sort of a long-term CPR of about 8.6. 2.5s to prepay around 9.2, and then 3s and 3.5s are going to prepay around 10.5 and 12.5 respectively. And then when you get to the 5s and 5.5s and 6s, we're really looking at prepayment rates around, say, 22, 24.5, 26.5 CPR for those coupons. So you can see our prepayment model is really kind of calling turnover in the 8 to 10 region, which I do think is a little bit higher than sort of market expectations.
Thanks, Glenn. So the market's general view seems, or at least to me, for deep discount 2s and 2.5 prepayments to kind of be around 4 to 6 CPR respectively. So based on the prepayment forecasts, it seems like your model must really like the discount sector here.
Yeah, you're right. The model does like the 2.5 coupons with an OAS of 78 and 69 each, right? It also favors the 3 and 3.5s, but less so with the OAS of 58 and 50. And then the OAS analysis and looking at the model's prepayment forecast leads me to the theme of one-sided optionality that we discussed in this month's prepayment insight. So still one cannot carry and book OAS. So the idea is to strategically add the one-sided optionality of the deep discounts. And that's going to mean different levels of exposure for different investors based on their unique objectives and constraints. But I definitely think this is one way to look at that discount sector and to think about it as part of your overall portfolio.
Yeah, thanks very much for that, Glenn. So, before we close the last podcast of the year, I'm going to put you on the spot a little bit here. We started in January with discussing some distinct themes that you have. So maybe we can kind of recap how your views played out this year.
Oh, yeah. Okay. Well, let's see here. December 2021, our issuance and net issuance forecast for the year was a range between, say, 600 and 800 billion for the net issuance. So, I kind of split that difference and call it 700 billion for people that prefer to have a hard number over a range. And so as of November's remittance report, net issuance stood at about 780 billion. So, it's going to come in a little bit to the higher end, I think, by the time December unfolds. Around 800 billion or possibly a little bit north of that. And based on the net issuance forecast, we initially projected a mortgage basis to widen, say, 20 to 40 basis points at that time. So we were looking in terms of absolute numbers for the basis to widen to around 100 at the high end. However, the basis just widened quickly in Q1 2022. It just took off, it easily reaching the upper end of our forecast. So we had to revise that forecast. I guess we're fortunate we could stick with our issuance forecast, but we had to change our basis forecast. And I don't really like revising forecasts without some context, around the revision, right? So and then also as well as questioning what changed to impact the forecast as it did. So in April, we did release a client note arguing that the mortgage basis was shifting to the old normal, right? Which under the old normal theme, we argued the basis should trade between 100 and 140 basis points, kind of in the normal sort of ebb and flow of issuance and demand, and 180 and wider under stress scenarios. And so currently the basis is trading 143 versus the 510 blend. I think we reached a high of about 175, so we were really close to that stress number that we had talked about. And then with respect to prepayment, we were looking for existing home sales to decline and turnover to decline in line with the long-term average, with the moderately seasoned cohorts kind of being the last to slow down to the long run turnover rate. And I would say, for the most part, that was pretty spot on. We talked in one podcast about the moderately seasoned prepayment, is kind of the party guest that would never leave, right? It just seemed that moderately seasoned cohort just had a lot of momentum behind it in terms of, originator mining and things like that. But here by the fourth quarter, prepayment in the moderately seasoned moderately seasoned cohort has slowed down too. So we're really looking at, as you said, sort of rock bottom turnover speeds at this point. So, overall, I think we did okay.
Thanks very much for that, Glenn. Well, you've certainly given our listeners something to think about, and I'm looking forward to your client note and kind of kicking this back off in the new year. Wishing you a happy holiday. And thank you to all of our listeners for listening to the MUFG Global Markets podcast. You could go ahead, rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And please reach out to your MUFG sales rep for any further information. Please check back soon for more insights from the Global Markets Research team.